as well. So what we're looking at here is just the 14-day free trial to Power Options. For those of you that are just getting started on your trial, I encourage you to take advantage of the 4 steps that are listed. Go through the quick start guide. You can review the flash tutorials. There's a variety of archive webinars you can access at any time, and trial members and subscribers can schedule a free coaching session at any time. That's essentially a 35 to 45-minute phone conversation with myself or with Ernie as well. Okay, let's see here. I got a question that came in from Barry. And Barry says, I'm new to your system. I'm looking at the trading history of your principals, I guess. There doesn't seem to be many trades made. I think it was EK's history, I guess that means Ernie's, which was about 6 per year. And the return is about 5% per trade. With that few number, doesn't seem to be much money made. Okay, so I think you're talking about the RadioActive Trading Fusion subscription, Barry. That's where we post our trades based on the RadioActive Trading techniques. And let's see here. Let me pause for 1 second. There we go. So we'll navigate over real quick to RadioActive Trading. Let me clear up the drawings. Go ahead and log in as well. Let's just take care of that. Let's log in to RadioActive Trading. Okay. So the RadioActive Trading service is related solely to the RadioActive Trading techniques and what's discussed in the blueprint, the limited risk approach. I'm sorry, folks. There we go. There we go. Sorry about that. On the Fusion subscription, you have a variety of lessons to help you master the techniques in the blueprint. The RBM report to find your own trades. It's also similar to the Power Options search for married puts, the default criteria that's listed. However, you can't make any adjustments to the criteria on this one as you can on Power Options. The stock insurance tool, members only webinars and white papers, and then of course the open trades and the trade tracker where Ernie, myself, and Greg currently post our active radioactive positions. And in general, you're right, Barry, about the amount of trades. And the reason why is you maybe have heard me say, honestly and openly, on several webinars, that I do trade this technique with my personal account. These are my actual trades in Sony, Interactive Brokers, Pulte Group, Canada Goose Holdings, and Ali. These trades represent 50% of my, 45 to 50% of my total trading account. So naturally, I'm only going to have 5 or 6 positions open at a time. The radioactive techniques are more of a longer term position rather than trying to do weekly covered calls or roll positions every 7 to 14 days or even monthly credit spreads or monthly covered calls. So we may stay in a position for upwards of 5 or 6 months. Now, to your point though, if we go to the track record, you know, for 2018 so far, we can look at Ernie's. I think that's who you're referring to. You can look at mine. But let's just go to Ernie's very quickly, and we'll just look back around 2017. And I think he only had maybe 9 trades open, but you can see his win-loss ratio over the last 6 years, number of winning positions, number of losing positions, 49%, about 50-50. But he averages about 10.6% winners on a trade when he's right, 5.4 when he's wrong. Using the trade simulator, you could see that over time after 100 trades, how that win-loss ratio could affect a portfolio. But I'm just going to scroll down here, and if we look at the positions that were closed or open in 2017, you see he does only have about 5 or 6, 7 or 8 positions that were open. Looking at notes that I did for another customer that I have a printout here who asked a similar question by email last week. 1, 2, 3, 4, 5, 6, 7, 8. I had about 8 or 9 positions in this portion of my portfolio over 2017. Now, there's 2 things I want to mention about these. Although these are our real trades, Barry, several of these positions at any time are not going to be simply 100 shares and 1 put. We do post that to keep the math simple, but following the rules of radioactive trading. So if I look at any position here, we'll take Planet Fitness for example. The initial trade was open, was posted as just shares of Planet Fitness based on 100 shares and 1 put with a risk of 160 or 6%. this trade in my portfolio was actually 300 shares. The reason why is because in the blueprint, we discussed that the allocation, in addition to having the low risk, the monetary risk can be up to, let's say, 1.5 or 2% of your total portfolio value. So if I have someone who's trading $100,000 and following the fusion trades, they might have traded up to 800 or 900 shares of this position to match sort of that monetary gain as well. Okay? And in this situation, oh, sorry, what I was doing there is this is 300. So maybe 3 or 4 positions out of the year won't be 100 shares. What I'm getting at, where I'm going with this, is if I wouldn't keep trading this if I wasn't making the profits I was expecting. I'd be honest with you. Even though we think the blueprint is a great product and it's a great technique to trade, if I wasn't making the goals, you wouldn't hear me saying I'm still doing this as 40 or 50% of my count. I would have dialed it down or stopped trading. Okay, but for the numbers that I had for what the customer asked was about from 2015 forward. So I had I had 10 positions over the 2014 to 2015 with a 12.2% gain. I actually lost about 12% on 7 positions, in 2016. 2015 was the 12.2% gain. 2016 was a loss. The total portfolio gain for my positions, the number of shares that I would have used for allocating Barry, was 25.5% in 2017. And as of July 18th, I was at a 12.1% gain on the 5 trades I have open right now. I had 1 closed already on AMAT, and I've got the 5 trades open right now in the radioactive positions. So I am meeting my goals. This is a conservative way to trade, but I am meeting my average of around that 10, 11% we talk about in the webinars for this strategy. Can other strategies make more? Absolutely, in the right time frame. We can always go back and second guess any strategy or anything we're looking at, of course, but if I had known what the market was going to do from 2016 to January, February 5th, I apologize, February 5th, roughly, 2018, I might have canceled out all of my positions and just bought calls on things like Amazon, Netflix. What were some of the other big gainers? Canada Goose in the last 3 months, one of the married puts that I'm in, that's gone from 36 up to 67 and has pulled back down now to about $61 or $59 per share. Hindsight's 2020. We don't have that luxury. Okay, but I am meeting my goals. The key to remember is that some of these strategies, some of these positions, my apologies, Barry, are based on more than 100 shares. And so the returns do come out equally to what we're looking to do. And then again, keep in mind that the idea is to long-term successes with what benefits the portfolio with the win-loss ratio. If this was reversed and I was losing money, I wouldn't be trading it anymore in my personal portfolio. Okay, so I hope that answers your question, Barry, and if I missed something there, please feel free to send me a follow-up to that. And if you want more details there, we can go through that later on as well for Fusion subscribers. Okay, so the next question I have that came in is from Rhajiv. Rhajiv has, I guess, a married put position on Intel where you sold a 52 call for August 18th. Not sure of any direction, bought the 52.5 call and 2 puts at the 50 strike for this week. All right, left with Intel stock of 100 shares. Okay, so what Rhajiv is saying, I'm going to go to the custom spread tool, is that at one point he did have a married put position. He sold some calls against it. He bought 2, oh, that's not where I wanted to go, I'm sorry. Bought 2 puts at one point in anticipation of the earnings that came out yesterday, my apologies, after the market. This is a little bit of decline here. You're still in a small profit, and so your question is, should you recreate the married put position, and you don't want to create a bear call spread, one of the income methods, until it starts trading above 50. Okay, well, it's taken a dip today, and you say you're just at about a small profit with it 47.73. If I were to you've got a small profit, of course. So what I would do is to analyze, is it a good time to continue this on as a married put or bullish position? Reevaluate if you're bullish on this after the earnings decline. Use the insurance tool. So let's say you've got, a cost basis of 46, so that your profit's about $1.73. I'm just making up a number, Rhajiv. Put that into the insurance tool. And then if I want to continue on, I'll leave it at all expirations, so it shows me there's January puts that are far out in time. I've got August puts available. But I really want to go closer to that 100, that January time frame. I want to go 150 days out in time. So let's look at January real quick. If I want to continue this as a limited risk position with the radioactive structure in play. And although the 55 put gives you the best bang for the buck in this case, and it's probably because of wide bid-ask spread, with the stock at 47.73, I'm still probably focusing somewhere in this range, just the 49 or the 50, maybe even the 48. And you see here you have a negative locked-in profit, so this would be your risk. 50 gives you about a 1.5% risk, the 49 a 2.2, and the 48 a 3.3. Why am I focusing on those ones in particular? Well, that's what we usually do, is we go slightly in the money to get the best risk protection and lowest time value decay. That's why we're going 175 days out in time. But it's really up to you as which one you feel is best. Now the 48 or the 49, if there is a recovery, might be slightly better because you could do income methods relatively soon because you're closer to at the money. If you go to the 50 or the 52.5, you'd have to wait now for the stock to continue to move up a little bit more before it made any sense to do the call adjustment or even the bear call spread against the position. So those are the numbers I'd look at. In this case, if you just have a small profit, just plug it into the insurance tool. That's why it's there. You can evaluate the numbers. And you can even see on this page 2, if you wanted to do a call right away, we could just put a sell call month for, say, August. And it would give us some different combinations of the collar structure. And I know that's not what you want to do. You want to use income method number 6, the bear call spread, to leave the upside open. Well, this might give you a starting point of where you might stand with any of the locked-in profit or the risk on the position as well with the initial collar structure. And let's go with the 49s. I'm going to go with the January 49 put and selling the August 31st 49 call right now for 88 cents. That's 35 days at a time, probably longer term than I've heard you usually mention in other questions on the webinar. But let's go to that profit and loss. Oh, sorry, folks. There we go. So this would be a collar now with a low risk of about 0.4%. Again, I'm basing this off a cost basis of 46. The January 49 put at 410, and the 49 call at 88. So you have a low risk of 0.4%, a max profit of 5.5%, but that's 31 days or so at a time, the 31st of August expiration. Now, income method number 6, the bear call spread, we could look at some opportunities here in the same expiration. We have to go to August 31, I'm sorry, it's 35 days out in time. But I don't want to take out more than a third of this, so I'm probably going to the 52 strike or maybe even the 53. That's a 4-point spread there. Let's stick with the 52 at about 25 cents. So we'll still retain about 63 cents of the premium. And why would I do this? If I enter this bear call spread in this structure with owning the stock, selling the August 49 and buying the August 52, which would be a bearish position, in this structure, it does give us a little blip, but it's still infinite upside and the risk is only 0.9%. Okay? But again, Rhajiv, I know you might want to go closer in time based on what you're doing. This idea and this concept is solely based on your expectations going forward for Intel. You're sitting on 100 shares right now. There's the big decline today. I would have liked to have seen the put be purchased before the weekend in case there's more decline before Monday's open. But in this case, if nothing happens on Monday, if it's about even, you could still get a good price for those puts to lock it in on that situation. Not lock it in, but get a really low risk, below 1%, and then you still have an opportunity to do the bear call spreads shorter term. But remember, shorter term, you're going to get a lower premium, so this might not be as low as 1%. You might have a 1.5, 1.6% risk in that scenario. So analyze what you feel if you're still bullish on Intel over the next few months, 2 months, 60 days, 90 days. If you are, then I would do it. If you don't feel that you're bullish anymore or the stock's just going to hesitate, you may just want to close this position, look for somewhere else. Close the stock for the small profit and look somewhere else for a better profit opportunity, I should say, for lack of a better term. Okay. Cameron. I had a couple emails with Cameron this afternoon. Cameron also just picked up the blueprint. Now, Cameron says, I have stock WBA with a January 70 put and a September 70 call. I'm total protected. Can't lose on the position. It's bulletproof. Now, the question is, in September, I am called out. Do I liquidate the put or continue more with the stock? Okay, now, Cameron just recently purchased the blueprint a few hours ago. It's going to be likely sent out this afternoon. It likely was sent out this afternoon. And you should have that within maybe 3 to 4 days. In the blueprint is a chapter on exiting the RPM position, Cameron. But before we go into that, let's take a look at your position. Look at WBA on the custom spread tool. And you have a January 70 put. And you sold the September, I'm sorry, you sold the standard September, I believe, 70 call. And so that's 5 and 1. So let's say that you had stock before at about $63. And I'll just use the numbers here. It doesn't matter what they are. I'm just going to try to get it to a bulletproof position that you mentioned with no risk. That's probably too much. I don't know if you're this much bulletproof. Let's scale it back a little bit. I'm going to put my cost basis up to 64, maybe 50. That's better. Okay. So we've got about, this is just an example of what it might look like. Bulletproof to the tune of about 3% to the downside, max return of 7.9. Okay, now, when you get to the, oh, you paid 65. Oh, perfect. Well, I'm just using the numbers that exist today, so they're going to be different. But let's plug in 65. Doesn't really matter too much. It's a good profit. You've locked it in. You've bulletproofed the trade, so that's the best part about this. But maybe some numbers such as this. Okay. On September expiration, what we're looking at here with the blue line hockey stick graph, the tense profit and loss chart, is your maximum profit. As the reason why this is your max profit, of course, is as the stock starts to move above 70, and this is at September expiration, naturally, not January. But as the stock continues to move up and you get closer to September expiration, a magical thing happens where the delta of your short call is going to 1. Okay? It's either going to be a 0 or intrinsic value depending on where the stock is. So it's going to a delta of 1. Now, your stock has a delta of 1, but remember the short call is a negative 1. So now any gain that goes forward, you're hedged out 1-to-1 with the obligation of the short call at 70, and your 70 put is declining in value. That's why it slips off. So, oops, sorry, folks. The question comes in, if you get assigned, or this, let's say the stock's at 72, 73.50, if the stock's going to be assigned at September expiration, if you let it be assigned, do you then sell the put? Well, number one, that's based on have you met your goals for the position. You'll see more about this in the blueprint. Okay, so I'm faced with a position where an income method number 1 is going to be assigned. And what do I mean by goals? If your target for this particular trade was 7%, let's call it 3.5% per month, or over 3% per month, well, over a 60-day period to September, which is, about probably closer to 40 days out, but let's say we did this a while ago, you're averaging about 3.5% return for each 30 days to September expiration. So if you've met your goals, yes, let it get assigned and sell to close the put for whatever time value it has left, and that'll get you into this profit range depending on where the stock is. Okay. All right, so let me just clear this up and we'll start from scratch. So yes, if you've met your goals for your return target, then I would say you could let it be assigned and then sell to close the put. Now, if the stock's at 71 or 72, I could also, this will be liquidate the whole position, get assigned and liquidate the put. If the stock's at 71 or 72, and either I haven't met my goals or I think there's more potential for upside profit going into October and November, well, you would just treat this like a covered call. That's called income method number 2. We just look for opportunities maybe to roll the 70 up to the October 72.5 or the 75 to see if the new profit and loss chart going to October also meets our goals for the next 30 days. Do we still keep the bulletproof status in that situation, or do we add risk to the position due to the buyback of the call? So we could just simply roll the call just as you would to stay in the position, either if you haven't met your goals or if you think there is more upside opportunity. A third thing that you could do, depending on your brokerage account, your level of trading as well, Cameron, is there's something called income method number 7. It's one of the 12 income methods. You'll get that when you get your blueprint. And what income method number 7 does, I can say, well, I'm going to allow myself to be assigned on this covered call position. I'm still holding this 70 put. Oh, sorry, let's say the stock's at 73. I'm still holding the 70 put. What I might do now is sell in October 72.5 put. Remember, I was assigned the stock. I'm out of the covered call. I own a 70 put. And if I sell 72.5, if the stock pulls back, I can get back at a cheaper price. I can get back into the stock at 72.50 minus the profit I took for the assignment on the stock, minus the new premium I just collected. You sort of create a calendar put spread. And if it goes up and it expires, well, then you can sell another one for November. Or just exit the position if you've met your goals at that time. What this all comes down to, anytime you're deciding, should I enter an income method? Should I adjust my current income method in the radioactive trade based on where the stock has gone? We call this applying the SIGA model. And in your blueprint, there's a chapter for each one of the income methods. Income method number 12 is lumped in with 4, and there's a whole chapter on combining income methods, combinations of 4 and 6, 3 and 1, 9 and 1, 12 and 6, and so forth with the different income methods. But what the SIGA model stands for, before you decide to enter an income method or make an adjustment on an income method, we want to look at the current conditions of the market and the position. Where am I now? What has happened since I've entered the trade? And then what are my expectations going forward? Okay, am I still bullish on the trade? Do I think it's going to fall back? Do I maybe want to add extra protection to sort of create a synthetic straddle against the long stock where I can profit in either direction? And then what are your goals? Have you met your goals yet? Are you just shy of your goals? Can you meet your goals by adjusting the income method to the next month from September to October, or does it actually hurt your goals because the buyback cost is too expensive? And the current conditions, the expectations, and the goals will help you determine your action on what to do next. So there's really 4 opportunities that you could use going forward if you hold this all the way to September expiration and you're going to allow it to be assigned. You could liquidate if you've met your goals. You could use income method number 2 and roll the call beforehand, matching the rules in the blueprint. If it does, again, continue to match your goals for the next 20 to 30 days in the trade. Income method number 7 is a possibility that's used, it's an income method that's used if I do get assigned, or if you get assigned early, don't want to necessarily buy the stock back now, but you still want to generate income and maybe get back into it at a better price. All right? That'll all be described in your blueprint. When you start going through income method number 1 and income method number 2, you'll see what I'm talking about. You could even jump ahead right now if you wanted to, when you receive your blueprint, maybe Monday or Tuesday, and go to that exiting the RPM chapter for ideas and concepts of when would you likely close the trade, when is it a good idea to get out of the trade, when to perhaps allow assignment, or when to continue managing the trade based on your SIGA model for the position. So that's what we look at going forward. Okay, so that'll all be there, but that's just a little refresher of the opportunities that you have, Cameron. And of course, as a blueprint owner and a current member of Power Options, just remember, as we get closer to September expiration, as WBA waffles up and down and you're thinking of doing, can give us a call anytime during market hours or send us an email. Myself or Ernie will be more than happy to answer your questions. Now, this question is a little different. The next question, I apologize, is a little different, and it's a little bit interesting, and it looks like it's from Dwight. Yeah, it's from Dwight. I'm sorry. A couple questions in a row there. I don't know which screen to best illustrate this, but I'm going to go to covered calls for the time being. Okay, I'm just going to go to basic search on covered calls, and let's go to the weeklies, the weekly picks of the day, to see what positions are available. Now, let's see the return here. Yeah, the returns are all, there's a really high one on MNK of 1.6% for next week's position. We usually open the picks of the day on Monday. That's how Ernie's testing worked when we post these trades. But most of these are around, 1%. Let's call it a good average around 1%. Now, Dwight's question is related to, he phrased it correctly, so I'm just going to read it straight out. Dwight wants to know, how much do I need to invest in order to replace my monthly income from my job? Okay, I'm not laughing at you, Dwight. I was just making sure I read that correctly. So how much do we need to invest to trade options to make up for the income we're making at a job? Okay. This comes down to what strategy you're going to be using. And it also, of course, comes down to what monthly income are you looking to make, right? So if we kept it simple and we just said $5,000, you want to make $5,000 a month trading options to supplement your employment income, to stop working and trade options so you don't have to work anymore, okay? And we want to make $5,000 per month. And if we're doing weekly covered calls, of course, we know that the average return is about 1%. Sometimes it's a little bit below that. It's about 0.9%. So in this case, you're doing weekly covered calls. You figure you get that 4 times per month, 4 weeks in a row. So we'd average 4% return with weekly covered calls per month. In the best case scenario, assuming no losses, no management, and so forth. So now the simple question is that what amount of money, naturally, is 4% $5,000 of? Okay, so for month by month, if you wanted to make $5,000, you allocated $200,000 to covered calls, you're going to be making about $8,000, but you have to start with $200,000 and allocate all of it on weekly covered calls. So you'd be averaging about $2,000 per week. Okay. However, to keep it on range, of course, you'd probably only need about 150, right? It'd be 150,000 times the 0.4 per month, and that would give you $6,000. So that would do it. Right? But you need to start off with $150,000 if that's your goal. Make up $5,000, $6,000, what your income goals are. So where I'm going with this is you can see it yourself. When you go into a search, now let's switch it to monthlies. Okay, so we'll just go to the monthly picks of the day instead of the weeklies. We know we'd average about 1% return. Oh, these are 21 days out. Now let's just go to standard expiration. Oh, that is standard expiration. August 17th. I'm sorry. I was looking at the 10. I thought it was August 10th. No, it's August 17th. And the returns are not that great. Yeah, they're only averaging around 2%. So if you did monthly covered calls to give you a little bit more premium, you might make 2%, but again, that's over the 21-day period. That's shy of the 4% we saw with the weeklies. But the weeklies, you'd be doing much more frequent trades, and you'd have higher commission costs over time. 4 times the commission costs, in fact. Okay? But depending on your strategy, Dwight, what you can do, and this is Dwight B, by the way. I think there's 2 Dwights here at one point, but this is Dwight B. If you look at bull put credit spreads, which I don't have on my screen, it's very interesting. So let's go to other strategies real quick. And I'm going to clear out butterflies for the moment. And let me put bull put credit spread back into our menu. There we go, bull puts. Save the configuration. Let's just go to a bull put search. And what we're going to see here, of course, is a leverage return, 13, 12, 11. So I'm going to say the average here, the top 10, 15 trades, 12 trades, excuse me, between 5.8 and 13.9 for our weekly bull put search that we tested as well. And this is going 14 days out for a reason. So we found the 14-day out spreads over time had a higher return than going 7 days out. But in any case, here we could say about 11% return on average, call it 11.1% with good probabilities, 88, 89%, 86%, and so forth. So in this case, you could say, well, if you needed to make $5,000 and you traded in bull put credit spreads, you wouldn't need as much. You'd only need maybe $45,000 to invest, but you'd have to invest all of it into bull put spreads, which is very dangerous, and I'll explain why in a moment. And that would give you about $4,950. So let's say $46,000. Based on the average return for the structure you're looking for, you can easily determine what amount of money you need to invest to match your goals. But I can tell you this, the danger of doing it with these leverage positions, buying calls, buying puts, thinking that you're going to make that income, doing credit spreads, is that really, in reality, the leverage positions, credit spreads, even calendar spreads, buying calls, straddles, things that can have high returns, they really shouldn't represent probably more than 10 or 15% of your total portfolio value. Because remember, in the bull put spread, although it's a nice leverage return, we're going to take the Lamb research here right at 12.9% return. I trade these in my personal account. They're good trades, but it only represents a small portion of my portfolio. Naturally, we're going out of the money for the best probability for security, but if the stock falls below 175, I'm at a 100% loss of what I invested into this position. It's a known risk. I know my maximum risk is only $222 on the spread because of the net credit I received. We're looking at a spread selling the 177.5 put and buying the 175, a $2.50 spread to get about a 29-cent, 30-cent net credit. Okay, that's good. It's a good return, 12.6, 13.1%, I believe. But if there is a fall, it drops 10, 15 points over the next 14 days or so, I lose that full amount. So if I did 5 contracts, so I collected $150 but at $1,000 at risk, I could lose that $1,000. Okay? You would likely put on 10 or 12 positions, as I mentioned, to get your goals, but look at it in this case. All right, most of these are 3-point spread, 2.5-point spreads, 2-point spread, 2.5-point spread, and so forth. So you need $45,000, $46,000 allocated to make that 10 or 11% on the leverage positions. If you only have $50,000 to do, I would not do this. If I'd opened positions on Monday, bull put credit spreads, we'll take a look at that in just a moment, but if I open bull put credit spreads on Monday, then I'd probably be in a bad position right now with today's decline, wouldn't I? And depending on how far out of the money I went, but we're going to look. We're going to see where those stand in just a moment. But then, of course, you think about the mathematics. So let's say we took the top 10 trades. You're allocating roughly $4,000 to each position of your $45,000. Okay, so $4,500. So on a 2.5-point spread, what we're talking about there is about 18 contracts a piece, roughly, right? Yeah, it'd be about 18 contracts in each one. Times the net credit here, 30 cents times about 20 contracts, you'd get about $600, right? Yeah. So yeah, that's right. Each one you're making about $600 on the net credit based on the allocation size. So 10 positions, you'd get the $6,000. But let's go back. Let's just take this, and I'm going to go into the back testing tool. And I'm going to go to the Smart History Excel. This might run a little bit slowly because right now at between 4:50 and 5:15 Eastern Time, what we're doing in the background is actually updating today's data. So into the historical tables, we're updating the data. So let's go to July. We're going to run a search for the weekly bull puts on Monday the 23rd, as it would have matched exactly from the criteria at the close. All right, Chuck, I'll get to your question in just a moment. I see it there. Let me finish up this thought, and Chuck has a comment to add on Dwight's. Okay. All right. Okay, so there were only 1, 2, 3, 4, 5, 6 positions. These are the 6 positions. Why does it say 17? It's because I'm only showing one result per security. The other spreads that match the criteria for the weekly bull puts were on the same stock. So 1, 2, 3, 4, 5, 6 stocks had 17 different bull put spreads that would have matched it. Okay, so and the return is lower. Return is not that great. This is for 11 days out in time, and we're about a 9% average, probably about 8.5%. Look at that, probably 8% maybe, but that's okay. So what I can do now is simply hit calculate group results. And what this is the one that's going to take a long time. What the system's going to do now is take those 6 or 7 trades as they were on Monday with the prices, and then it's going to show me, when I hit calculate group results, it's going to show me where we stand right now. If I had gone back a year, it just would have shown me where those positions I opened at 14 days to expiration, where they stood at the end of expiration. What that allows me to do, of course, is if I had run this a year ago, on July 23rd, 2017, I would have seen 8, 9, 10 bull put spreads that match the criteria. And then hitting calculate group results would have shown me on August 2017 which ones would have been profitable. How do I use that? Well, what I do is the historical search here allows you to create your own search. You can also do it in the main search and then transfer it over, as you just saw that I did. But then I can go through and say, okay, what would have matched my criteria 12 months ago? And you get your 10 trades. And then you hit calculate group results, and it shows you that 5 out of 5 trades were successful, and you had an average loss of about 4.5%. Say, okay, maybe that was just a bad one. Let me run it from August 5th, Monday following this Friday, 2017, and see if I get better results. And then you see only 4 out of 10 were successful. Well, now it's telling you your search criteria aren't working out. So you'd want to tweak your criteria and go back and even look at the positions. Of course, you can look at the positions individually to see information on what was going on at that point, what did and did not make sense on that position going forward. Okay, so that would help you to say, look, these 4 that I lost on, FedEx, Adobe, and XYZ, all seem to have negative earnings, and we're trading below, the MACD was trading below the signal line. So maybe I should change that criteria and only look for positive MACD and positive earnings to see if that gives me any better results. I filtered these out, but let me go forward now and see if that happens. That's how we use the back testing. Oh, sorry. So let me find our report here. It's still loading. There it goes. Okay, so of our 6 trades, right now 4 out of 6 are successful and are an average return of about 1%. We're losing on the Adobe 247.5, 245, because the stock's at 254.81. But that's not a loss. Okay, it's at a loss right now if I liquidated, but the stock's still above my upper strike price, so this could still expire worthless. 519 here, that's still above the 495. In fact, it doesn't look like any of them have gone in the money yet, which is good. So even though right now, liquidation-wise, 4 out of 6 are successful, losing 8.5% on one due to the option price, and we still have 7 days to go to expiration, we're only averaging about 1%. Okay, so after this, yesterday, this would have looked completely different. I probably would have had a higher profit, and 6 out of 6 might have been profitable before today's decline in the tech. And, you know, yeah, 4 out of the 6 are tech. How about that? So that's just a bird's eye view of how you can use the history and the risk of trying to use $50,000, a portfolio of $45,000 or $50,000, and allocating all of it to the bull put spreads. Because if you have a bad cycle, remember, you can lose 100% of what you invested in a spread very quickly if there's a black swan event, sudden market downturn, unexpected bad news, or anything of that nature on the stock position. And remember, because of the structure of these trades, 22 cents on a 2.5 point spread, 21 cents 2.5, 98 cents on a 5 point spread. If I took the full 5 point loss, this could actually wipe out 8 or 9 previous trades. That's the nature of spread trading. So even though you're right 90% of the time, you may come out of the month with a break even or a small loss, not getting the $6,000 or $5,000 you were hoping for. Okay, so let's get off of that note there, but that just allows you to see how you can use the back testing and also how the spreads have worked out from Monday if I had opened them to today. Okay, now, it was Chuck. I almost said Charles. Sorry, Chuck. Chuck's comment was he wants to add to Dwight's question that you only trade married puts, how much money is feasibly needed to make $5,000 a month? Okay. Now, as I mentioned, I like to trade about 45%, sometimes 50% of my total. I'm at 55%, I think, right now with the positions I have. It's because of a management technique. That's not important. In any case, how much would I need to make $5,000? Well, I talked to you about the average that I make. My goals with the radioactive trading technique over time is to average between 10 and 12% per year, and I've been able to get that consistently. Now, some years there was a losing year, but you make it back later. You know, the 25.2% from last year's trades, as I looked at the numbers with what I had 200 or 300 shares in, monetarily was a 25% gain on what I started with that year. In any case, that was a great year. I know investors that did better than me in 2017 doing covered calls, long calls, calendar spreads, percentage-wise using leverage. The rest of my portfolio, I'm doing calendar call spreads, bull put spreads. And I did perform better on those portions of my portfolio in 2017 to the beginning of 2018 over the radioactive trading techniques. Why didn't I move more over? Because I know over time, when you have a loss on a bull put credit spread portion of your portfolio, it's going to wipe out 10 to 12 previous months of gains. It's going to have very drastic swings. That's the lie of leverage. Okay? Whereas the married put technique is extremely conservative. We are paying extra money for the insurance, and it's a much slower trade, but it's also putting time on our side and putting the risk on our side so we control it to single digits. To answer your question directly, Chuck, think about it this way. I'm looking with perhaps a 10 or 12% annual goal on the radioactive trading techniques. Let's just call it 11%. Yeah, really, I'm looking, trying to improve that to 15% this year and last year. And I kind of came close, and then I didn't so far this year. In any case, no, I was at 12.2%. This day took out about 1%, so I'm only at 11. But in any case, so Chuck, where I'm going with that, that average is about 1% per month, doesn't it? Maybe a little bit less, maybe a little bit more. I'd like to be at 15 to average sort of like a 1.4% return monthly average on the radioactive trades. So then again, 5,000 is 1% of what number? How much would you need to invest to do that? If you're trying to only trade the married put positions, and right away you can see we're talking about $500,000. If my target, my average is 1% per month on the radioactive trades, you want to supplement income. And this is also very tricky to say it this way, Chuck, but you want to see $5,000, you need to invest $500,000 based on what I'm getting. And there are radioactive traders who do better than I do. They pick different stocks and they do different adjustments. But here's the key. I don't calculate it this way for investors, meaning that I'm not, you might say this is a different way of doing things in some cases, or a shady way of doing things, and I'm not trying to be shady, I'm very upfront. This AMD is not a real trade. It's something we did in the webinar. We put in a webinar for a client, and then we tracked it and evaluated the income method. This is not one of my real trades. This is our webinar account. You see my real trades. Some of my real trades are in here. Didn't expire that call. Didn't take care of that income method number 6 on this webinar account. This is not my real account. In any case, ADM is 90 days old, and the stock is ridiculously gone up about 100%. Maybe that's not a good example. But let me see. It was Sony's not a great one. Oh, no, Sony's pretty good. Now, because I've been in it for too long, 186 days. All right, long story short, let's say that we did get in Sony a little while ago at 49.75. We could have done that. Let's say it was 60 days ago. And we bought the stock at 49.75, and we bought a January 55 put for 380. And right now the stock is up 365, and I've lost 155 on my put, so I'm still making $210 on the position. Yeah, $210, I'm sorry, on the total investment of the trade. So let's just take a look at it on the profit and loss chart. And let's assume we didn't do, oh, this had an adjustment. I do apologize. Let's go back to 49.75, shall we? Okay, let's go back to that cost basis. We synthesized an income method. I'm sorry. There we go. So it's a 6.6% risk. I have about a $210 gain on the stock on the married put position as a whole on an investment of $53.55. So that's about a 3.9% return in 60 days. I'm just taking this as an average. So okay, we're averaging about 2% per month. And that's pretty good. It's beating my expectations. Now, here's the dilemma. I would probably be doing an income method now with a stock at 53.40. Selling a call, doing income method number 4, another adjustment on this position. But if I left it alone and I haven't done anything yet, I've made $210, and if I had 300 shares, it'd be $610. But I haven't made that yet, have I? I didn't sell premium against it to take in the $610. It's an unrealized return. And when I open a married put to begin with, I don't want to sell a call because that would cap the upside and hurt the position. Okay? What do I mean by that? Let's just take a new married put from scratch. And I open this position on, are any of mine in here? Probably not. Valero looks decent. I like that. Nice round number, 5% risk. Let's use Valero. This is not a recommendation or suggestion on a married put or opening Valero or any bullish sentiment on Valero itself. I just like the numbers. Okay, so it's a 4.9% risk. I'm buying stock at 116.35, buying a 120 put. Because of this cost basis, I could only do 100 shares even if I did it. Normally, I don't go above $85 per share on a married put because of my portfolio size, as we talked earlier. Now, Chuck, you say, well, how much would I need to invest? Let's say I did $500,000. And with a risk of 618, 1%, I'm sorry, we'd trade about 800 shares, I think, right? Because I want this to maybe represent 1 or 2%, between 1 and 2% of my total portfolio value. So if I had $500,000, because I want to average that 1%, I put about, yeah, really expensive there in that case. So my risk is $4,944, right around the 1% of $500,000. Risk is only 4.9%. But you want to generate income. You want to take the 5 or 6 positions you have open and you want to try to make this $5,000 or $6,000. So you're not going to wait and you say, let me go to August 17th and let me sell a 120 calls only at $1. So that'd be $800. And if you had 6 positions open, you'd only make $4,800. So maybe you want to go lower. You want to go to 150. So you sell the 118. Right away, I'm breaking 2 rules of radioactive trading. I never want to sell the call right away, and I never want to sell the call below the put strike price. Now my risk has gone up to 5.3%. I might make close to that $952 or $1,000 on the position because I generated income. I did generate $1,256 on the position, but it's a position as a whole. If the stock's here, it's really on $952. But you did take in the $1,200. If you have 5 positions open, you'd be close to the $6,000. We're investing $100,000 here on 800 shares to do that. But again, the maximum profit's only 1%, if and only if the stock is trading right at 118. And the risk went up to 5.3%. How is that possible? You sold a call, which should lower the risk. You didn't increase the risk to the downside. You increased the risk to the upside. Because remember, your cost basis was $126.10. yes, you brought that down by the call, so it was about 126.10 per 100 shares, 116.35 plus the 983. We're at 126.10. You took in $1.50, so we dropped that down to about 124.60. But now you've sold a 118 call, which is $6 below your cost basis. So if the stock suddenly gapped up to 125 or 126, what happens? You get no more gain on the stock because you're hedged out with the call. The put loses value. You now have two ways to lose. So if I don't sell this call, the stock moves up 3% in the first 25 days. The married put's going to have a profit of 1.5 to 2% because of the put hedge. I made 1% on the position in the first 30 days, 1.5% on the position, but it's not realized. And I haven't sold a call yet. So that's why where I'm going, you can see where I'm going with this, Chuck. That's why it's really hard to say that even though my goal is to make 1% per month on average, I'm not necessarily generating income at 1% per month with this structure, because I can get myself into trouble if I don't follow the rules, try to force an income method and force premium where I can take a much higher loss to the upside because I didn't follow the guidelines in the blueprint. Okay, that's why the blueprint is important when implementing this technique, the hows and whys of when to use each one. And as I mentioned, I may hold a position for 3 or 4 months, and then when I close it, I might have a 6 or 7% gain. Well, that gives me the average I want of 1.5, maybe even 2% per month that I'm looking for to get to my annualized return that I experience with these positions, the strategy, I should say. But if I force it too soon, I can hurt myself in the trade. It's not really for income necessarily, it is for growth. All right, I'm looking more for growth. However, if the stock did shoot up and exceeded my expectations, even without doing an income method, I might just liquidate the position if I think it's plateaued, take my, let's say, 8% profit because the stock had a 12% run. I'll take my 8% profit, and yeah, I've met my goals for that month, and I'll move on to a new position. But again, just from what I said, that the goal is around 1.5, maybe 2% per month, really around 1.5% per month, well then, how much would you need to make 5,000? That's what it would come down to, and we kind of showed that. Okay, so let's see. I got a follow-up question here. I got 2 follow-up questions. I'm sorry. That's from Cameron. Okay, he said he's thinking 60 radioactive and 40 covered call. Anything you would add to the portfolio composition because you're moderate? No, Cameron, since you're just getting started out, I'd say start off with that first and see how it goes. And if it's not matching your goals, we can look at other things. Okay, I think that's a good way to start, but we'll see how things pan out, and we'll be able to see if they're panning out how you want within the first 25 to 45 days probably. And then we can talk about other positions. You'd mentioned that you're conservative. Well, the 2 most conservative strategies using options are the married put radioactive position and standard collar spreads. Again, calendar calls, bull put credit spreads, even buying calls, they have a known risk. You know going into it what the monetary risk is, and based on your number of contracts, you know that. But it is not a controlled risk. You can still lose 100% of whatever you put into the position, and if you overtrade because you fall into the trap of leverage, you could hurt yourself really bad with diagonals, with bull puts, bear calls, iron condors, and of course even just buying calls and buying puts if you're not disciplined. Okay, is this Rhajiv? Yes. Rhajiv says, Mike, does it make sense to create married put positions on stocks less than $15 in price, or better to avoid those? No, that's how I started. Do I still have it up? I do. Oh, good. We're still in the, sorry, I flipped over real quick without telling you what's going on. Went back to RadioActive Trading. I'm in my track record. I'm going to go to the last page. When I first started, I met Kurt. We got connected with Kurt back in 2007, 2008. That's when I started implementing the strategy. And believe me, every question you've thought of to ask about the radioactive trading position or detraction, I already grilled Kurt over it back in 2007 and 2008. I didn't want to do the married put. I wanted to do it as a calendar put spread to get in the stock at a lesser price. Found out that was the wrong way to do it with actual trades. I thought about doing an in-the-money strangle instead of a married put. That didn't work out either. So I ended up going right into the married puts in my positions. So roundabout, very sorry. The first few positions I opened, because I was only allocating a small amount of capital to my account, were $20 in Office Max, Fossil at 12 at the time. Oh, it was, okay, this was another one. This was at 40.76. I'm sorry, that wasn't the one I was thinking of. Domino's Pizza was the one I was thinking of. It was $13 at the time I got in the trade, $13.22. And I started with stocks under $15 per share because that's what I could afford. There are opportunities in the lower price ranges. At Domino's here, the best one, of course, was Silver Wheaton, one of my first trades, and that was at $17.20. Of course, the stock went up 130%, so yeah, naturally it's going to make 60-70% on the position. And Rare Elements REE wasn't a great trade, but it was a 1250 position, and I turned a 3% return in 90 days. 1% per month, not great, but the stock was down 1% the whole time I was in the trade. Right? So I've had decent luck with those, but as my account started to grow, I started getting into the bigger price stocks. I went through a gold phase, Yamana Gold, 1715, New Gold Inc. I thought I saw another one in there, Talisman Energy, Plains Exploration, so on and so forth. But these were all lower priced up until I started getting more money and went into bigger positions. Okay, so I think it's a good idea. I think it's an okay idea to do, to use married puts on stocks that are maybe under $20 per share. Do I have one now? No, I really don't. In my open positions, I'm sorry, that was rambling. That was a comment that came in and says, do you have any positions that are under $15 now? No, I don't. SNE, or Polte is the closest one at 28.13. Okay, so that's the one I have there is the closest one. But yes, I did used to, let's go back to the married put search. Let's see. Now, okay, it wouldn't be here. I think it's in my actual account. I have about 40, no, not 45. I've got about 15 saved searches in addition to the defaults that I've done over time. And there's one that's married puts under $25 and one that's married puts under $20 that I was using back in 2007 and 2008. Very similar to the criteria you're looking at, just made some subtle adjustments to the criteria. Okay, got, oh, okay, there's just another question here. This is the last one at the moment, it looks like. I don't know the name here. Just came through as my work. So from my work says, on a married put structure, would it be a good idea to add an extra put out of the money to mitigate the at-now curve in case of a decline? For me, personally, no. What do I mean by that? Let's go back again to Fusion. I want to go to the track record. And the win-loss ratio I have is about 60-40. And it's really close. It says 59-41, so it's about 60-40. Now, this is for total positions, but it's also actually true in my portfolio, and it has been, is that around 60 to 65% of the time, I pick stocks that do exactly what I want, meaning that move up 3 to 6% in the first 30 days. And it's about 65% of the time. So in that structure, and on the other ones that don't move up that much, 1 out of 10, now probably more like 1 out of 20, would drop more than 7 or 8% from an unexpected event in the first 30 to 60 days. Really the first 20 to 40 days is what I'm looking at. And then the others, there might be one that falls 4 or 5%. That's still manageable. I'm probably only taking a 2% loss on the trade. Because it's just the first 20, 30 days, I still have 5 months left of time premium or more. So I'm not at near the full loss yet. Now, in those situations, so 60% of the time, 65% of the time, they go up as I expect, based on the criteria we've used and what we've adjusted. The rest of the time, they might fall 1 or 2%, and then one position out of 10 might fall more than 5%, and then 1 out of every 20 might just completely fall out of bed for an unexpected event that could not be seen on a chart, the news, anything. It just happened, and it goes down 8, 9, 12, 15% in the first 20 to 30 days. I don't think over time, with what I've been experiencing, is that buying the extra out of the money put up front first would have improved my results. I think they would have hurt it. Once out of every 20 trades, once almost every 2 years, when you saw, what we went through the track record there was one that maybe dropped 10% where the extra put might have given me a 5% return off the bat. But I would have given up 2 to 3%, maybe 1 to 2%. Let's call it 1 to 2% on the other positions that didn't move. So let's say we're talking about 20 positions here. Probably 15 of those that did move up 3 to 6%, I would have only had, instead of having a 1.5 or 4% gain in the first 20 to 30 days, I probably would have ended up having a 2 or a 1.5% gain. And then the one that dropped 10%, I might have had a 5% gain, and all the others that were in the middle, where I might have been losing 0.5 or 1%, I now would have been losing about 2% because of the extra cost of the additional put. So for me, it wouldn't have worked out over time. I don't think that would have hedged it enough over time. I have done it, okay, but it's done differently. Okay, there is an income method that talks about that, and there's 2 ways to do that income method, and I may open a new married put with an extra put if, see, I wouldn't do that on Valero because it's already past earnings. If I opened it on Holly Frontier, which has earnings in 6 days from now, or on PBF Energy, I might buy an additional put playing a synthetic straddle that only has a single-digit risk. It's a possibility. Let's take a look. We'll go PBF. And this one here would buy stock at 45.71. Earnings coming out in a few days, 6 days. I should have reviewed that when I was there. Ernie's going to be mad at me that I didn't show you the new feature on the site right now. But I'll get back to that in a minute. So buying the January 47 put for 520 gives me a max risk of 7.7%. No earnings are coming up in 6 days. I got to go out to August and let me add $1. Now let me add a little bit more than 50 cents with the 42 put. Okay. Now the graph we're going to see at this point is for, standard August expiration, not January. The risk goes up to about 5.2%. Or did it drop? I'm sorry, hold on a second here. PBF Energy is 8%. Oh, okay, so we did drop the maximum risk because of the extra coverage. Okay? But we moved that break even up so much. Now, we moved that up to 47.61 for the additional 50 cents from $47 roughly. Okay, so we moved this over. And we don't even see where the new break even is. What the rest of this graph does is you'll see something like this, and then it'll start to go back up like this. But we don't even see here where the second break even is before this starts to pay off. I'm going to guess 51.43 with the 42. So yeah, I'm going to guess it's going to be at around 39. What happened if the stock is trading at $39.88 the day just after? Nope, not quite there. Still be at a loss about 50 cents. Hasn't kicked in yet. Let's go down to 38. And that should give us maybe the delta we want. Yeah. So around 38.20, 38.30 is the lower break even. Okay. And we increased the upside here. We increased the upper break even to 45.71 with the additional cost. It's not a bad idea, but I don't know if this structure is right. Could I do better a different way? Yeah, and that's in the blueprint. So I wouldn't do it every time. And of course, if I think I'm in a bear market, there are different ways to play it. I could play it that way, buy 2 puts to 1 to create a straddle or strangle. If I think I'm in a bear market, normally what we might do is just trade a married put on an inverse ETF, which will go up as the market goes down, so I don't have to think backwards. Okay. Okay, Rhajiv has a follow-up here, and we're going to show it with this stock to keep it simple, but we're going to change the numbers. Rhajiv's talking about income method number 6, the bear call spread. And the bear call spread is typically done out of the money, or at least where the short call is above the put strike price. Oh, where did So I don't mean to bounce around a lot here. Well, a good example might, no, I'm sorry. Let's not mess around. I'll just do this. I'm going to change the numbers, Rhajiv, on this position. We're going to say we got into PBF Energy at 46, and we bought, I'm sorry, not 4, I meant 44. We got in at 44, and we paid $6 at the time for this 47 put. Okay? It's $1 lower, 80 cents less. Still about a, wow, those numbers are good. No, I'm kidding. I knew they were going to be. 6%, $300 even. But now the stock's moved up to 45.71. It's not quite at 47. If I felt the need to do an income method number 6 now, and we can only use August expiration, this doesn't offer weeklies. What I would do is sell the 47. I'd like to buy the 50. I'll buy the 50, okay? Because it's equal to my put strike price. Just like income method number 1, the same rules apply. This is still an income method number 1 with an extra kick. It does create a bear call spread, but it's really income method number 1, and the same rules apply. I don't want to sell in the money below the current stock price. I want to sell the call at or above the put strike price, not below as we saw before on the $116 stock where we increase the risks to the upside. Okay. Now what happens when I do a bear call spread? I've sold the 47 and bought the 50, which is actually a bearish transition. But because I own the stock, what this does is that the obligation of the bear call spread, the margin requirement, doesn't exist. That short call is covered by the stock. And the long call gives me infinite upside. So even if the stock jumps suddenly up to 55, 56, or 57, I have infinite upside. Even if they call my stock away from me at 47, I've got a 49 call that's gaining in price, a long 49 call that I was paid to own. On the other side, if I just have to close the spread out for the $2 or $3 loss in this case, minus the 70-cent net credit we took roughly, but if I have to close it out, that's okay because the stock has moved up more than I'm giving back between these two strikes, and I still own the stock. And that's the benefit of income method number 6. But this is still an income method number 1. It still obligates me to potentially deliver shares of stock, even though I have an extra long call. Real quick, anytime I do an income method number 6, this is where I want to be. I want to have a profit and loss chart that doesn't go back into the negative and comes back up, which happens if you try income method number 6 too soon. Okay? I want all of this to be positive and still infinite upside. Now, if I went the other way, with a stock at 45.71, and I sell an in-the-money 45 call and buy a 47, still going to get about $1 net credit, but remember, depending on my broker, that still may obligate me to deliver shares of stock at 45. I don't really like this. Even though I got a higher net credit, I'm pushing back down to that lower level, and the max profit's not nearly as high. Okay? The upper peak isn't as high, the lower low is much lower, and then it takes longer to get back up. Now the last break even, the highest upper break even was dropped down a little bit more. But remember, on the other one, I didn't have an upper break even. I was profitable the whole way. There was no dip back down into the negative or close to it. And if we went deeper in the money to get a better premium, let's say I sell a 44 or 43. We'll go 44 for 240 and then buy the 47 to try to get a higher net credit of $1.60 or so. But now I'm giving up the shares potentially at 44, even though, yes, I have a long call in place at 47. That's not what I want to see. The profit now is the profit is only at 44. I have infinite upside if the stock goes above 47.68. But if I stay where I am right now, I'm making $6, $8, loss of $40 here in the middle. If I'm bullish, why would I do this? I want to give that stuff more upside and look at the higher strike as well. Okay? So that's why I don't do it, Rhajiv. That's why I don't do it in the money. Now, if I am going to use the other example I was talking about for a moment. Okay, let's go back. I'm going to go to the portfolio. And this is, let me just do this real quick. Let me just expire these 2 legs. That's not what happened, but this isn't the actual record of the goose trade. That's on RadioActive Trading and, of course, in my other portfolio. Good stuff. Okay, so Goose. Cost basis of 49.80 on the position. It's trading at 58.98. Was it 62 the other day? Was it 63 almost on Monday? It was 64 last week when I had to buy back that 61 call for the income method number 6. Not mad. And I've got an October 55 put. Okay, so let's go ahead and take a look here at the profit and loss chart. Now it's bulletproof to 1%. But let me do this. I'm going to adjust this down a little bit. I'm not cheating. I just want to show you something. Once you get to 5, 6, maybe 7% of a bulletproof position, our stock's at 58.98, Rhajiv. Now, if I'm thinking about getting out of the position that I'm thinking I'm okay if I get this position assigned for me and I lose it, there might be some potential upside if the market recovers from today's downdraft. All right. Maybe now that I know I'm bulletproof, let's sell a 57 and buy a 59. Okay? And premiums are high, but they're not going to be that great comparatively. I'm going to get about $1 net credit for this 3-point spread, and it still gives me what I want. Okay, I do dip back down here to a profit of 1094, 555. The most I can lose on this position is nothing. The worst case scenario is a positive 555 return, or 11.2%. So if you have a bulletproof status and you're thinking you want to get out of the position, this is a possibility. Never do it if you still have risk, because you're going to find out it's probably not going to do what you want. Yes, the upside's open, but unless you have a significant move, that doesn't help you. You actually put yourself in a loss position on an average move of 1 or 2% over the next 20 to 40 days to expiration. You shouldn't be expecting to see 6, 7, 8% moves in a 20 to 30-day period on a stock that hasn't been moving for you. Okay, that's gambling. All right, that's over expecting the stock. That's an over expectation on the stock. My apologies. But if you are bulletproof, you can do it. But if I had just gotten into this position today, or not today, but a while back, and let's say I bought the stock at 52, and I had the 55 put at 470, so my investment would have been 56.70. I have a risk of 170 on the position. Now the stock's at 58, and I do this spread. That's still not too bad. Okay, this one didn't look too bad, but it's because I still have a gain on the position. If I opened it today, I would never do that. If I've only made one adjustment, moved my risk from 6% down to 4%, I wouldn't do that at all. I would never even consider it. I follow the rules in the blueprint, and this one is okay for 2 reasons, right? This one, Rhajiv, worked out, as we saw, for 2 reasons. Number 1, we had that lower cost basis. Number 2, I am still selling a call above the put strike price. In this case, it's in the money from where the stock is, but it's still above the put strike price. If these 2 calls were below the put strike price, let's do a 50, 53. This sounds silly, doesn't it? Right now, the stock at 58 to do a 50, 53, even if we're bulletproof. I'm sorry, I didn't grab the right thing there. But I would never do it. I'd never consider this. Okay, so there's this RPM with about a 3% risk. Wish I knew why that keeps resetting. But now I'm thinking I'm out of the position, so I'm going to sell a 50, buy a 53. It's just weird. I don't think I would do it this way because it dips down here. It still looks pretty good, but remember, it's a profit of 536 now with the spread in place because I'm already giving back the 3 points, right? Think about it this way, Rhajiv. The best case scenario for an income method number 6 is that the stock's trading right at the short put strike or the same distance above the long call strike, not at the long call strike and not too far below the short strike that you sell. If you do this in the money, what are you essentially doing? Well, you're taking in a credit. In this case, is about $2.40 on a 3-point spread because they're both near intrinsic. Okay? So you're getting a net credit, but you have a 3-point spread that cancels each other out. What does that mean? By doing this in the money, even though you took in a net credit, you're automatically giving back 60 cents. You're admitting that you're losing the 3 points here to generate $2.40 of net credit. You're going to have to close this at some point and give that back. So this is adding 60 cents of risk to your position when it's liquidated right off the bat. That's what happens when you do the in the money. You're admitting that you're already setting yourself up to increase the risk by taking a loss. Because the net credit is always going to be lower than the difference in strike prices. You're going to have to close that at some point if you want to stay in the trade, right? Or your broker is going to close it out for you, and you lose the difference in the strike prices, so you add to your risk on the position. You go the opposite direction. You want it to have room to grow to the upside in addition to the net credit that you receive. So that counters the difference in strike prices on the bear spread. Otherwise, if I sell it in the money, if it's a 2-point spread and I got 50 cents, guess what? When my broker closes this out because it's in the money, I've just admitted to adding 150 to my cost basis to increase my risk, not lower it. The only way it lowers it is if it's below both strike prices in that scenario. Or if it really, if it just keeps shooting up to the moon, fine. But you got to close that at some point, don't you? And if it's in the money, that's not going to work out for you. You're adding to your cost basis. Okay, so I hope that's kind of clear. You don't ever want to see it go to the negative. If you do it in the money, you're going to have to close it for the difference in strike prices. You're going to have a higher probability of closing it for the difference in strike prices, which is going to be higher than the net credit you received. So unless the stock does still continue a movement upwards that counters that, you're actually adding to the cost by having this in the money. Okay, so that's where that goes. Now what I wanted to show you, I forgot to mention, let's go back to the married put search. For those of you who are Power Options members, I should have pointed this out earlier, I apologize. We updated some of the information we have, and you probably saw it before. But the earnings dates, before we just had the earnings date listed and the days remaining to earnings, so 826. Now, we actually had this on the stock tool, and in the portfolio view, when you look at the important dates tab, but we weren't showing it on the searches, now we are. So what it's telling you is if the earnings are confirmed or unconfirmed, CONF for confirmed, unconfirmed of course, unconfirmed 25 days away here, confirmed, and BO before open or AC after close. We didn't put after market because AM naturally could imply AM meaning morning. So AC is after the close, BO is before open. So this stock here on 8/2 is going to have before the open announce earnings, and that is confirmed. And that was that PBF Energy we were looking at. So that's the new notation that you have now in the earnings date fields on all the searches, search by symbols. Of course, it was already being shown on the research tool, the stock research tool. Whenever we looked at those, we'll just go to PBF Energy and go to the research for the stock. And you've got, here's say before market confirmed. So it doesn't quite line up with the acronym there, BO and AC, but yeah, before market instead of BO, and then it would be after market, but we don't want to show AM because that's, when you just see it as 2 letters, that could become confusing. But that's a feature that's now there as well, so that you have a better gauge right up front when you're in the search of when the earnings are expected and if they're confirmed or unconfirmed in that case. All right, well, ladies and gentlemen, I don't see any other new questions that have come in. What I'd like to do now is just navigate back over here. There we go. I just want to remind everyone that today's material are my thoughts on your questions designed for educational purposes, for increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct trading suggestions or trade recommendations. Options, as we've seen, do involve risk and may not be suitable for all investors. There will not be a live webinar next Friday, but I will send out an email and an archive for everyone with topics that were discussed during the week, during the trading week. And there also won't be a webinar on Friday, August 10th, but we'll have a lot of other information we'll pass to you during those 2 Friday periods. Remember, if you haven't yet, you can test out Power Options for 14 days with no credit card required. Just put in your first name, last name, and email address and click Start My Trial Now. You'll have full access to the 20-minute delayed data service for 14 days. We do offer an inexpensive end-of-day service, but the data is only updated at the end of day, close of market, really around 5 o'clock p.m. Eastern Time. So you don't see data changing during the day. And you miss out on some of the features, search results by email, the picks of the day, access for the searches, and the testing results as well. That is all available on the delayed for only $60 per month. And of course, we saw the back testing tools today. That's available on the historical and the premium service. The historical service is $100 per month. It gives you everything you have with the delayed, with full access to the historical data, the searches, historical option chain, and the historical search by symbol with data going back to April of 2006. Of course, we do offer a real-time service. Every time you refresh the page or run a search, you're getting the numbers and calculations at that very instant as well. All right, now, if you want to check out some other free education, remember you can check out the blog at any time, blog.poweropt.com. We didn't actually reference it today, but as mentioned, you can go to the webinars page at any time, poweropt.com/webinars.asp. If you're logged onto your trial, just click the free webinars tab under the main home tab. And, but it is a public page. You don't need to have a trial to access it. Just go to poweropt.com/webinars.asp, and you can go through all of our previously recorded webinars on the Power Options tools, our thoughts on the various option strategies, discussions on options concepts, Greeks, implied volatility, managing positions when it's might not be time to manage, where you might not want to manage for the sake of managing. You can always check us out on YouTube as well under Power Options. Now, if you think of any other questions later on this weekend, or maybe even later on this evening, just send me an email at any time to support@poweropt.com. You can also reach us at support@radioactivetrading.com. And of course, you can call us during the week at market hours at 302-992-7971. And for trial members and subscribers, of course, you can schedule a coaching session at any time. That's that 35 to 45-minute phone conversation with either myself or Ernie. Well, ladies and gentlemen, that was a fun, great discussion. Thank you for your questions this evening. I hope everyone has a fantastic weekend, and we'll talk to you all soon. Take care now. Good night.